As millions of Americans continue to struggle with the $1.7 trillion in outstanding student loan debt, a few states with declining populations have come up with a few solutions to attract new residents. An offer to pay off their student loans. All this and more in today's video. Hello and welcome to Stephen Carlson Show. I'm Stephen Carlson. I'm a tech entrepreneur, real estate investor, author, YouTuber, paramedic, and we've got Bonnie down here and Clyde, he's out by the pool. Forbes is reporting that multiple states, including Illinois, Maryland, and many others, are offering programs to eliminate your student loan debt. For example, Illinois' SmartBuy program does exactly that, and they can pay off up to $40,000 in student loans for borrowers who purchase a home in the state. Some studies have shown that borrowers are struggling with student loan debt and are far less likely to get a mortgage otherwise. Now, before I go any further, a very quick reminder. As my regulars will know, I have a team of outstanding lawyers that used to be kept chained up in the basement with Clyde guarding them. But since I moved to Florida, we don't have basements, so I guess now the lawyers received an upgrade and they get to hang out by the pool. Anyways, the problem with these lawyers is they give a little bit rowdy whenever I make a video, and the only way to calm them down is to give a quick disclaimer. I'm not a lawyer, I'm not a mortgage broker, I'm not a tax advisor. This is not legal financial tax advice. You get the point. Also, while I have you here, don't forget to check out Webull, link down below. Deposit $100 and you will get 2 free stocks, and you'll make Bonnie really happy. Of course, if stock investing is not exactly your thing, you could also check out the video that is pinned below where you can get the equivalent of 40 free lottery tickets every single week without any risk. Okay, enough of all that, let's get to today's video. Here's how the Illinois program works. SmartBuy will pay up to $40,000 in student loans, or a student loan balance of 15% of the purchase price of the house, whichever is the lower amount. The program can also provide $5,000 towards the down payment or closing costs on top of the student loan assistance. This can really go a long way, as many FHA programs require only very little down for first-time home buyers anyways. That $5,000 can really help. Eligible prospective homeowners in the Chicago area have a limit that they cannot have a household income of anything greater than $109,000. There is a maximum limit on the purchase price of the house, which ranges from $325,000 to more than $500,000, depending on where you are in Illinois. Importantly, partial payments are not allowed. The borrower's entire student loan balance must be paid off in full with this program. So if that $40,000 does not cut off your total payoff, then borrowers will need to find additional funds to pay off the rest of their student loans before they can close on the property. Second homes are not eligible for this program, and it must be the borrower's primary residence, as they must live there for at least 3 years or pay back a portion of the student loan if they end up leaving any sooner. Unlike other student loan mortgage programs where the student's loans are just basically wrapped into the mortgage, which you have to pay back, the Student Smart program does not require you to pay back this money. So how it works is for every month that you live in the house, 1/36 of the total student loan will be forgiven. So after 3 years, 36 months, the full amount will be completely forgiven for you. While this type of program is not a solution for complex student loan crises that impact millions of Americans, it provides genuine, meaningful assistance to borrowers who are struggling with student loan debt and cannot purchase a home as a result of this. In the meantime, debate continues in DC over a broad student loan forgiveness. Last week, the Biden administration announced that they would be exploring potential legal actions that they could use as a basis for widespread student loan forgiveness, implemented through an executive action. Something that President Biden has resisted, but is not taken entirely off the table. The Department of Education will coordinate its efforts with the U.S. Department of Justice, reviewing any possible legal avenues for students for loan forgiveness using the executive authority. Going back to the state programs for a moment, Maryland also offers a similar program called the Maryland SmartBuy 3.0, which allows home buyers to purchase any home in Maryland that meets Maryland's mortgage program guidelines while paying off a student loan debt. Some of these requirements for you to qualify mean that you must have a student loan debt with a minimum of $1,000 balance, and that the financing provides up to 15% of the home purchase price for the borrower to pay off their outstanding loan debt with a maximum of $30,000. The entire student loan, similar to the Illinois program, but the entire student loan must be completely paid off with this program. Approved SmartBuy mortgage lenders financing through the entire Maryland state program are available only through approved SmartBuy lenders. These lenders can confirm your eligibility and ensure that you meet all the applicable requirements. Now, don't worry, you don't need to memorize these things. I've linked to these programs down in the description box below. But of course, what if you don't live in one of these states? Don't worry. I'm also including a resource that shows state by state what your options are. Now, not every state offers the same type of program, but many have some sort of program that they can help you out, especially if you're in nursing or if you want to become a lawyer. Why would you want to become a lawyer? Then you'd be hanging out with Clyde. Well, actually, I guess by the pool, it is a bit of an upgrade, come to think of it. Better than the basement. But if those programs aren't exactly for your needs, there's also the option of rolling your student debt into your mortgage. But this has many pros and an awful lot of cons. Quicken Loans provides a great article to detail this. I linked it down below. But in summary, the pros include when you roll one loan payment into another, known as debt reshuffling, this is because debt isn't really gone. You just kind of moved it around. However, there are several advantages to using this strategy, including minimizing monthly payments. One of the most complex parts about taking on multiple debts is multiple monthly payments can very quickly become overwhelming. By rolling your student debt into a single mortgage, you only have that one payment to make instead of 2, 3, 4, etc. This could give you much needed breathing room in your budget. In some cases, it does reduce your interest rate by rolling your student loan debt into your mortgage. So you'll likely end up having a much lower interest rate. Lower interest rates could end up saving you thousands of dollars over the life of the loan, but there's a follow-up con to that in a second. You also can take advantage of tax deductions. You can deduct the interest on your mortgage loans up to $750,000. However, you're really going to need an accountant, and remember, I'm not one. Like everything else in life, there are many pluses and minuses to things. And unfortunately, I think there's more minuses to this strategy that kind of outweigh the benefits. You're going to lose all the federal protections. Remember, when you took out the student loan, many of them came with certain borrower protections. For instance, you can apply for income-based repayment plan or request forbearance if you fall on hard times. You will lose these protections by rolling your student loans into your mortgage. You also put your home at risk. Rolling all of your student loans into your mortgage will make your mortgage balance much higher. If you're unable to make these payments at some point, you're putting your entire home in jeopardy. Then you honestly usually end up paying more money in the long run. When you refinance, yes, you'll get a lower interest rate like I said a few minutes ago. However, you end up paying on this loan much longer. So instead of a 5-year or a 10-year student loan, now you have a 30-year. So you're paying interest on that for an additional 10, 15, 20 years. The biggest problem that I see here is if we presume that President Biden will discharge or give some sort of forgiveness for student loan, that's only going to be for those that still have a balance. So if you refinance your student loans into your mortgage, you will most likely get nothing from the federal government in a way of forgiveness. You will still owe all that money to the bank on your mortgage, and you will either end up having to pay it off over the next 30 years or when you sell the house. Thank you very much for watching. Please make sure you click like and subscribe. Doing so really helps the YouTube algorithm. I appreciate it, as does Bonnie that's currently sitting on my foot, and Clyde that's hanging out by the pool guarding those evil lawyers. Thanks, and I'll see you on the next one.